Hi there, and thanks for listening to the Adulting is Easy podcast, where we make adulting easier by making money easier. This is your host, Lauren, and I haven't asked you guys this in a while. Please stop, rate, and review at the end of this episode. On Spotify, for example, they won't let you rate if you haven't listened, so you may not be able to do it right now if you're new, but please do that. It helps us out a lot. All right. On to the episode. I'm joined today by David, a.k.a. UncommonYield, a financial educator and teacher at Cashville University. He takes a unique approach to personal finance that teaches you how to get the most out of every dollar. UI is married with 4 young kids, is Midwest born and raised. Find him at UncommonYield on Twitter and Instagram. Thanks for joining me, David.
Hey, thanks so much for having me, Lauren. Excited to be here.
Yeah, I'm glad to have you back. And as usual, our goal for today is to make adulting easier for listeners by discussing a personal finance topic, since managing money is a big part of adulting. So today, David, you and I are going to talk about bonds. So let's start with the obvious question. What are bonds?
Bond. So a good way to think about a bond is it's an IOU. So a corporation, a government, they need money to finance their operations or make a capital project. So they say, okay, investors, we need this cash and we'll pay you a certain rate to be able to, for you to loan that money to us. We'll pay you back over time.
So they can collect taxes and pay for stuff, or they can use bonds. Is that right?
Yep. Mm-hmm. Yeah. From a U.S. government standpoint, yeah, municipalities, yeah, or it's like a promise on future tax cash flows. So maybe your municipality, they say, okay, like we want to build some new roads. That's a big capital expense all at once. You don't do that all the time. We're going to use future cash flows to pay that down.
Got it. So we hear a lot, and you have yield in your name. What are bond yields?
Yeah, bond yields. So that's the rate that they get paid out. So typically bonds are sold in $1,000 increments. So if the bond is sold in $1,000 increment and there's a 5% yield on that bond, that means you would get paid $50 a year. Now, depending on the bond, you could get paid monthly, quarterly, semi-annually, or annually, or some bonds you even get paid like at the very, very end. But that's what that yield is. And those, depending on what's going on in the market, new bonds being issued, what their yield is, and what the appetite is for investors, how risky investors think that those bonds are, the rates will fluctuate up and it'll fluctuate down.
As that happens, what happens to the price of existing bonds?
Yeah, so I like to think of this as a teeter-totter. So as in general, as yields go up, the par value or the value of the bond goes down. Now that sounds confusing, right? But what the market wants to do is it wants to match bonds that are currently in circulation, what their yield is, to the yield of new bonds being issued. So if you had a bond that was 4% and new bonds are coming out that are paying 5%, that bond value needs to go down on that 4% bond to match the yield on that 5% bond. So the whole ecosystem is constantly bouncing up and bouncing down. Now, there are other factors that go into it. There's also duration on bonds, which I know is a question we have coming up here. But when you think about that teeter-totter, the longer that duration, that's like the length of that teeter-totter board. The longer it goes out, the more that price can fluctuate up and down. The shorter that teeter-totter, the less it's going to go up and down. So that's kind of, if you think about it, that's the best visual I have to think about is bond yields go up, prices come down, and vice versa.
So side note, teeter-totter, I think we call them seesaws down here.
Okay.
So that was awesome. That might be a Midwest thing. I'll have to check on that. Okay, so we talked about yields. You mentioned duration. From what I remember from school, duration is sort of a way to compare two different bonds with different coupons and yields. Is that accurate?
Yeah, there's a few different things that you need to calculate to say like what the value of the bond is right now. So because what you're trying to do is say, okay, what are the value of these future yields in the future? Like time value of money, right? There's a lot of complicated equations, but essentially you're looking at what the current par value of the bond is. So usually it's $1,000 increments. That's fairly standard across the board. Then you have what the yield is on the bond, what the current market yield is. Now, a lot of times that's like the 2-year is what people use as like the risk-free rate. But then also you have duration of the bond. So when does it mature? So that typically bonds are sold, depending, they can be sold in 30 years, or T-bills can be shorter, a couple years, sometimes they're 6 months. It really depends. Any permutation that you can think of in bonds, they're out there and they exist, but that's like, when does that $1,000 get paid back? So if you like, so let's say, for example, I bought a bond and it's $1,000 bond and it's 5%. I get paid 5% and it matures in 10 years. I'll get paid $50 every year for 10 years. And at the end, I'll get my $1,000 back. Is how it works. But that duration really depends on what's going on in the market and what that organization needs.
So you mentioned the 2 year,
Mm-hmm.
the 2 year, the 10 year, the 1 year. What are we talking about?
Yeah. So that's the average of those durations. So bonds that are gonna mature in 2 years, or mature in 10 years, or mature in 30 years. So a lot of times you've heard probably a lot about like yield curve inversion at the moment, right? That's when the 2-year yield is higher than the 10-year yield. So what that means is investors are thinking that in 10 years, rates are going to be lower than they are right now. So that's typically when you hear about like inversion, but that's just what bonds at that duration are paying in yield.
And that means a recession's coming, supposedly. Like if things are better than now, then they're going to be, then that indicates like people think maybe a recession's coming, supposedly.
Yeah. I mean, I think when you look throughout history, a lot of times what happens is, and this is what's happening, at least like right now, right? So we had inflation that went up. One of the things that the Federal Reserve can do, like they essentially set interest rates for a lot of the market. It's more complicated than that, but they essentially set interest rates because they set the overnight rate where the banks give them money and they get paid out. So they set that interest rate. People think, all right, the Feds are increasing rates because inflation's really bad, but inflation's not going to be bad forever. We hope in the future they're going to have to cut rates too. So the Fed's trying to kill demand. They're trying to essentially take the market down a peg by increasing rates, and eventually to help the market recover, they'll reduce rates. So it's a little bit of a game that we play in our current system, but just understanding what that game is and how it's played and what the market participants are trying to do is really important.
I think something that key that you said there's what the Fed is doing is setting the rate that banks basically borrow from them. And then and then other rates are derived from that. But I just wanted to point out that the Fed is not sitting there being like, all right, mortgage rates today, 7.5 instead of 7.25. It's not exactly like that.
Yeah, and you have to think too, like there's different levels of risk, right? When you borrow. So the risk that an individual borrower on a mortgage is not able to pay their mortgage is a lot higher than the federal government being able to pay out their bonds, like the interest on their bonds. So federal government can print their own money. Unfortunately, I haven't been able to figure out that trick to print my own money, but and neither has anybody else legally, anyways. So that's where that difference happens. That's why we see that the distance between those two is that risk.
And that's a key tenet of investing is risk reward. You're not going to get a 10% return on the, I mean, depending on interest rates, but you're not going to get this high return on the most safe thing. That's why you see some of these high returns, but people are taking generally big risks to do that. That's just how finance works.
Yeah, 100%. And there's some like really weird stuff going on in the market, like we were talking about earlier. It's really out of whack right now. So we're defying gravity a little bit in the market. We've got some asset classes that carry more risk that are yielding the same as what you would get if you bought a bond, which is really, really, really fascinating in the market.
Yeah. So say more about what's going on right now.
Yeah, so I mean, there's a few different things that are kind of happening in the market that are really fascinating. So one of the things that is going on in the market is the Federal Reserve said, let me find the date for you, but I think they said in like September, October 2021, they said, hey everybody, hey market, we are not going to raise interest rates. We're done raising interest rates. We think inflation's under control. Don't worry about it. But then when they go and they do, they raised interest rates a bunch. But in the meantime,
Like a
banks
lot.
bought like a
Like they raised
lot.
it
Like
like
the
a not a teensy tiny bit.
yeah, it's the fastest. Like when you look at the percentage of not like percent, like 1% to 2%, but like going from 1% to 5%, like 500% that they changed the rates. It's the fastest increase that we've ever seen in history, faster than
So
we
they were
saw in the
like
80s.
they were like epically wrong about that.
Yeah, I mean, yeah, just totally epically wrong. So they were epically wrong about that, but they told everybody, hey, we're not going to do it. So what did banks do? Banks went and they bought a lot of long duration bonds. As we talked about, long duration bonds, thinking about this seesaw or teeter totter, right? They react most to that interest rate increase. So we saw, so TLT, it's a long duration bond fund. It's gone down like 50%. When you look at the biggest corrections ever in history, it's almost on par with the Great Depression, and it's like the worst drawdown ever that we've seen in bonds ever in recorded history. Just
Well,
epically
because
terrible.
so this is what happens. People are buying bonds. These bonds are on their balance sheets. And
Mm-hmm.
then what did we just talk about? Say these bonds are at whatever, say 3%. Then there's bonds on the
Mm-hmm.
market that are, say, 6. I'm making up numbers
Yeah.
here. Obviously, those 3% bonds, which they already bought, have gone down in value significantly and they're still on their balance sheets. Now, my question is, did they have to adjust their balance sheets?
In a normal market, yes. But what the federal, but one would think, but what the Federal Reserve did to prevent a bank run, right? So we heard a lot about potential bank runs in the spring and early summer. To prevent that from happening, they said, okay, banks, you can come and you can take your bond portfolio to the Fed, and we'll give you loans based off the par value of the bond. So we'll assume that interest rates are still 3%, and you all would just have to pay us a minor interest rate to be able to take that loan out. I think now that was for a couple years. So we'll see. We're going to start hitting that in about a year or so from now. So we'll see how everybody responds. We'll see how the Fed continues to extend that program. When they did that, though, they effectively injected like $2 trillion worth of liquidity into the system, which is just crazy to think about from a number standpoint. Is that like the same as we saw the great financial crisis, or the same when COVID happened? No, it's not the same effect or impact, but that's the scale and magnitude of how short the banks were in the financial system, which is just incredible.
And it went mostly unnoticed to the outside world.
Oh, 100%. I mean, people don't think about like, this is a dry topic, right? So only a finance nerd like me on Twitter is talking about bonds and worried about bonds and worried how it's going to impact the financial system. Most people don't think about it, but this is at the core. It's like the undergirding of the whole financial system. So you think about how real estate, like that. So that's what you all are doing in Adulting Easy and House Money. Real estate, it's all valued in bond yields and cap rates. The stock market, bond yields and cap rates. Everything that we can think of is valued in that realm. So as they rise, yields and everything else has to rise, which means prices and everything else has to fall. Essentially, will that happen? I don't know. It hasn't happened yet, really, but it should.
What does it mean that bonds are the underpinning of the entire financial system? What exactly does that mean?
Yeah, so it's the most liquid market that's out there, and that you just have to think about the scope and scale of how much bigger the bond market is than like the stock and equity market. I can't remember. I don't have exact stats like right offhand, but it's a tremendous amount bigger. And when you think about so you think about pension funds, and you think like a lot of those are mandated to have a certain amount of bonds in their portfolio. Sovereign wealth funds, they're mandated to have a certain amount of bonds in their portfolio. So when you have all these like mandates out there, that those folks can't that are constructing this portfolios, managing this portfolios, they don't have any control over it. They have to abide by those mandates. So when they're abiding by those mandates, they get really crushed. They can't manage it differently. There are some ways they can get around it, but it's very, very difficult at scale, the scales that they're working in.
Should individuals be holding bonds?
I think so. I think they're a great deal right now. So I mean, you think about heck, like even like money market funds, they're like over 5%. So if inflation is it's like lower right now, which every indication is it seems like it is. If it's 2%, like you're still making like a 3% real rate on your money. So I think even if you're younger, I think there's a real strong bull case for bonds that we hadn't seen before in our lifetime. So what we've seen from the 80s until now is rates have gotten cut and cut and cut for the last 40 years. Right now, that's being reset. So at some point, I think the Fed is going to have to cut rates. The market can't handle it. The banks can't handle it. Heck, I was telling you earlier that the US government in 1 month added like $600 billion in interest debt. A lot of the debt the US funds itself with is short duration securities. So they're very interest rate sensitive. Like they have to cut rates. It's not sustainable to keep rates where they are. So I think it's a good, pretty low risk trade at the moment. Now there's not no risk, right? With any trade, like the government, maybe bonds are worthless at some point. Like if we talk about government bonds, maybe the US ceases to exist. Probably unlikely, right? But
I hope so.
uh,
If that
I hope
happens,
so
like
too.
there are so many problems. I'm not be worried about my bonds. I'll tell you that.
Yeah,
If that
yeah, yeah, yeah.
happens.
We've got way bigger problems. We have way bigger problems if this doesn't work out. So I think it's a really good place to. I think it's a really good place to hold money, honestly. So I moved about 30% of my 401k individually into bonds at the beginning of the year. That's probably bad timing. I should have waited until now, but you don't know. So I think yields come down into that 3% range, which seems fairly normal. Will we stay this high? I just don't think that these 8% mortgage rates, it's 8.25% now for like a 30-year mortgage. It's just not sustainable right now
No,
in the current
no,
market.
and it's very bad for adjustable mortgages and commercial because all commercial
Yeah.
loans are adjustable in the United States. And a lot of people think, yeah, 30-year fixed, but like anything bigger than a 5 unit, anything commercial, these all
Mm-hmm.
have these adjustable rate mortgages. And when are those coming due? I would like to know because there's going to be some massive hurting. And I have two of these types of loans myself, but one was 7 years. So I have five left, and one was five that I took out this year. So
Mm.
I'm hoping that we hit a little bit of equilibrium in there in the next 5 years. So,
Yeah, it's
uh,
crazy. It is crazy.
so when I asked you how, if individuals should own bonds, you said, yeah, no matter how old you are. Why would
Mm-hmm.
you bring age into it?
So the older you get, the less risk you should take. And bonds, in theory, are less risky, right? So it depends on how you want to invest in bonds. There are different ways. You can buy individual bonds. That's a little bit cumbersome, to be honest. You can also buy bond funds. And then in with bond funds, there's different, they focus on different duration typically. So you have ones that are short-term duration, you have ones that are mid-duration, and ones that are long-term duration typically. If you're younger, those longer duration bonds, they're a pretty good deal right now. The likelihood that that rates are going to be cut, like we talked about, is pretty high. If you're older though, like you really can't take a whole lot of risk, right? You need to make sure that the money that you have. So shorter duration bonds are probably a better bet for someone at this point, but it depends. It depends on everybody's individual um, specific situation, how much money you need and cash flow you need. But it's a pretty awesome place to be for some folks that are later in life that are actually living off their portfolio if they didn't see a big drawdown to convert a lot of their equities into bonds and get a guaranteed cash flow. Like that's pretty nice. And we haven't seen that for the last really 10 years.
The Simple Path to Wealth is a widely accepted book with it's the simple path to wealth. It's if you don't want to know a lot about this stuff, you can just own, I think he says 75% S&P 500 and
Mm-hmm.
25% bonds. A lot of
Mm-hmm.
people, when you see studies done, it's like 50% stocks, 50% bond portfolio. But some level, most people say that you can basically decrease the volatility of your entire portfolio if you have both stocks and bonds. So it sort of depends on
Yep.
age, like David said, because if you're like 25, you can take more risks than somebody who's 75. And also, really rich people, they have a lot in bonds sometimes. Like I think Susie
Mm-hmm.
Orman once said, I have everything in bonds because she's so wealthy that whatever bonds are throwing off is way more than enough to support her lifestyle. So it really is just personal preference, personal risk tolerance, and where your personal finances are.
Yeah, and it's, do you want to be active in your portfolio or totally passive? So me, I do a little bit of both, right? So I like to be a little bit active, and I think this is a good long-term swing trade that I'm trying to make. Eventually, I like to be mostly in equities, but if I can get this kind of yield on bonds, that's a nice steady income in my portfolio. It gets distributed across everything. I get to buy equities at a lower value. That's a pretty good deal, but very very individual. But it is that nice ballast to your portfolio, because typically what happens is when stocks drop, Fed cuts rates to try to help the economy, and bonds go up, and that's typically what we see.
Mm-hmm. Yeah, bond prices, right?
Mm-hmm. Correct. Yep.
So is there anything else you'd like to add, David? I think that's all I had prepared. Is there anything else you want to add before we wrap up?
No, I mean, I think this is just a primer. There's a lot you can learn about bonds, but I encourage you to look into it and read about it a little bit more. Go to Vanguard, see what kind of funds they have. Go to iShares, see what kind of funds they have. Look at the prospectus. If you read that, it's a little dry, but if you're going to put your money into it, especially if you're going to put a lot of money into it, take the 10 minutes to read the prospectus and see what's in there. Just continue to learn a little bit more, but really encourage you to continue to learn about bonds and really understand what you're investing in. It's really important not to just put money in and not know anything about it. I encourage you to really understand it well.
Yeah, they really don't get their due in the personal finance
Mhm.
education space. I feel like I don't see enough about them, which is why I asked you to come on and talk about them.
Yeah, and what's kind of funny is, if anybody's followed me on social media for a while, back in 2020, like I was like the biggest bond hater ever. But that's because rates were at zero, like almost zero, right? There was like no yield out there, and I'm like, the rates can only go up for here. This is from a risk standpoint. You only have downside risk. You don't have anything on the upside. What are they going to do? Go do negative? It's very unlikely here in the United States. They have gone and done that other places, but very unlikely in the United States. But now that bond rates are good, like, all right, let's change strategies, right? Let's change strategies, and now it's a good time to buy bonds. It's a good time to have bonds, and I'm a big fan.
So remind everybody where they can get in touch with you.
The best place to find me is on Twitter. I know I'm on Instagram a little bit too, but I probably post there about every 3 months. So come find me on Twitter. Come ask me questions if you like the episode. If you have a question, like, please at me, and we'll continue to have conversation about it on Twitter. I would really love that.
So you're still doing the Twitter. You're not on X. You're
Oh,
still calling it
X,
Twitter.
yeah, yeah. I'm still calling it Twitter. I can't make the change. People calling it Zeets and reposts and like, whatever. It's so silly.
I do
It's
okay
Twitter.
with X. I can't do the Zeets. There's still tweets to me.
That's
All
awesome.
right, guys. So on whatever that platform is called, you can find me at Adulting is Easy, on Instagram at Adulting is Easy Real. YouTube is at Adulting is Easy. This video will be there. Unfortunately, David is anonymous, so only I get to see his face. You guys don't. And the website, housemoneymedia.com. If you guys like this episode, you may also like my past interview with David, which was about credit cards, which is episode 102. And thanks again for listening, everybody. Hopefully, David and I made adulting a little easier for you.